Hi guys, my name is Christian Ross and I'm an attorney here in Naples, Florida. I have three companies, Ross Title, Ross Law, and Ross 1031. I think it's pretty clear what we like doing. We like doing real estate. And so I've done a lot of videos on conventional financing. I've done videos on seller financing. This one is kind of what happens after those deals close? What can be expected? And how do I evaluate this kind of transaction for my clients? Is this a good option? So I really think this one's an interesting one. A client of mine called me today and said, Christian, we did the seller financing, and I've been getting calls seemingly every week on whether I want to sell my loan, sell this note, this paper that I hold to a third party. What does that mean? So I thought that was a really cool topic that we could talk about today. Now, before we get to that topic, I kind of want to give the quick on how do you evaluate and how do you even find yourself in the situation where seller financing makes sense? And how do you evaluate the risk reward situation for that buyer and seller? So first, the way I always look at transactions and negotiations is there's price and there's terms. And you're usually not going to get both. You may get, in this case, the buyer's going to get their terms, seller financing, over a couple of year period. But the seller should be getting their price. Or maybe it's something in between. Maybe I'm not getting exactly the price I wanted, but I'm also getting pretty good terms. I'm getting kind of a big benefit on that end. And that's kind of how this situation came to be. The buyer was really interested, wanted to make the purchase, but needed the seller financing to make it happen. So it was, I think the buyer ended up putting 20 or 30% down, and the seller financed everything else. So the buyers, for the last 6 months, it was a 2-year loan from the seller to the buyer. They closed. The buyer took title. It's in their name. They filed for homestead. They've been paying the insurance, the condo fees, the association fees. They've been maintaining the property as well. And they've been paying the mortgage every month since we closed. So the buyers definitely take on a lot of cost and maintenance responsibility. The seller's been getting mortgage payments every month, and at the 2-year mark, that on this particular situation, the 2-year mark, the buyer has a balloon payment where they're going to have to pay the entire balance of the loan. And sometimes they'll do that by selling the property, but most of the time they'll do it by refinancing, maybe getting a loan with a conventional lender. So in our example, there's about a $1,067,000 balance on this loan. So the buyer owes the seller $1,067,000, and it's about 18 months from maturity. Uh, at closing, a note was signed by the buyer and a mortgage was signed by the buyer, and that mortgage was recorded in public record. And that's where the fun starts. So the seller is a secured lien holder on the property. It's recorded down at the courthouse. But there are companies that they kind of look at the recordings and they want to track what's happening. And they found that this is a private lender. The seller, offered seller financing to this buyer. And so they sent a letter to the seller and said, "Hey, would you be willing to sell us your rights under that loan, where we'll step into your shoes as the lien holder?" And the seller asked me, "Well, what does that even mean?" I said, "Well, let's do the math." And so I'm going to share my screen so that you can do the math with us. I thought it was a really neat opportunity to share this with you guys. So for $1,067,000 note, in this case it was 7% interest only, with 18 months remaining on the note. It produces monthly interest payment of about $6,200. There's about 112,000 in total interest that will be earned over the next 18 months. And then there'll be the balloon payment for that full balance. Now that's assuming the buyer makes every payment and that they're not late, and that they don't want to just pay it off faster. Because it is possible that the buyer could, just say, "Look, I'll pay it off right now. Here's a check. I'll pay it now." So the buyer of the note is really buying the right to receive 18 monthly payments plus the 1,067,000 principal balance at the end. So we have to decide, what is that worth to the buyer If, to buy that now, what would you pay to receive that stream of payments over the next 18 months? And then from the seller's perspective, is that attractive? Is that something the seller would be wanting to do? And maybe the seller has some other property they want to buy, and this would allow them to do it. Maybe they're getting a better deal than the terms of this mortgage. Or maybe they just need it to live. Maybe it's not $1 million, but it's something less and more simple. And this would kind of bail them out. Maybe they didn't like that they did a seller financing. From the buyer's perspective, they kind of look at what does their target yield need to be? What do their investors demand be the return on investment? If I'm buying a loan at 7%, that's good, but maybe I want a 9% or a 10% or an 11% return. And I'm kind of taking advantage of the seller needing to get out of this loan in order to juice my profits. So I did a quick analysis and I said, well, if the buyer's demanding a 9% return on their money, then they would only offer $1,037 and 160 $1,037,161. That would, if they paid the seller that today to step into their shoes, that would basically almost guarantee a 9% return to the buyer. And then you can see the numbers and how they kind of go if you wanted a 10%, 11%, all the way up to 18% return. So I could, if I was this investor, I said, well, I demand an 18% return on my money. So here's a $913,000 check. Here you go, Mr. Seller. And then I'll just step right into your shoes and I'll receive those payments. And if the buyer makes their payments for the next 18 months, I'll get my 18%. But there's always a possibility that the buyer defaults. They don't make their payments or they go into foreclosure. So in this case, what I was expecting and what I told my seller is, they'd probably write you a check for like 1,025,000, somewhere in that range, or maybe $1 million. They'd probably start in that range, hoping that you'd take it and you push back. But do you want the 1,025,000 today, or do you want to just wait for 18 months and get the full amount? Um, this is kind of what it wanted to look like. You're probably getting, 90%, 95% of the face value of those payments, and then you discount it based on the interest rates that the buyer might be wanting to achieve. So not many people see this side of these transactions, and I thought it was a really interesting thing to show everybody. Couple of big points I want you to remember. Price versus terms. And this is one of those terms that if your seller can offer it, it could demand a higher price because of that. And in this scenario, getting a 7% return, that's not too shabby. As long as you did your due diligence on that buyer and you got a big deposit to kind of protect the downside, I think that could be a really good investment for somebody. But sometimes the timing doesn't work out. And that's the other thing I want to point to. You don't get to decide when the buyer pays you. You can have an agreement, you can have terms, but sometimes the buyers don't pay. They either don't pay at all or they don't pay on time. And you kind of have to weigh that risk with your own, risk tolerance, not just in a vacuum, not just looking at 7% returns or 9% returns. You have to kind of understand that risk and be comfortable and be able to take that risk knowledgeably. So I hope that you really find these videos fun and entertaining and hopefully educational. So if you have any other topics like this, please don't hesitate to ask. And I wish you the best. Good luck.